that I can share my.
All right.
Okay, so that I can share my screen. Okay. Thank you so much, guys.
I'll do just that.
Okay. So, guys, you are welcome. Please, I want you in the course of the meeting, please ensure whenever you are gaining value, be leaving chats with us. I want you to be writing, don't just be dormant, participate. While he's talking, while I'm talking, you can be participating by writing something, and then it will be very wonderful. Thank you so much. Okay, guys, I'm going to be bringing us some few things as normal, and I want to start from here. Okay, I believe you can see my screen already. You see, I love to be practical, and I love to ensure that you understand that you are at the right place and that nobody is taking advantage of you. I believe you can see my screen. This is for the disclaimer. This is not MJ Young account. This is actually one of our traders account. This is today's trade from one of the traders accounts, and I just wish to share it with you, and then make sure that also I'm going to be talking to you much more from that. And secondly, I'm going to share maybe a second file with you guys. I don't know. Okay, this is the IS social. You can see it. This is I have been having a couple of testimonies from people that are copying me. This person has made 14% return. We have just taken 2 trading sections. This person has made 14% return on account. So when we say copy MJ Young on the IS social, it is very, very important. Like we said yesterday, you can make money while learning. You can make money while learning. Please take it to heart. You can make money while learning. It is possible. All you need to do, use the link. You can talk to Cassie Eri. My link is available on the Telegram. It's available on WhatsApp. And you can also talk to Cassie or chat me, chat anybody. They will give you the link. Open your account, verify, fund it immediately, start making money while you sleep. Please, it is very, very important. So I just wanted to show you. I wish there is time, but maybe Saturday I'm going to show you more testimonies coming from people. For today, I wanted to do this. Now, I'm going to start this meeting in the next 10 minutes. I'm going to be speaking, just 10 minutes. I'm going to be speaking to you because it's important. It's part of your training psychology for what I call the law of value. I know I want to first of all also welcome our Indian guys. I have been told 4 people from India are following us on this training. And yesterday I was quite impressed when I had a chat and somebody was like, in India, by this time it was, by the time it was like 4 a.m. in the morning, 3 to 4 a.m. in the morning. It is so amazing to have people follow you from different parts, and what I'm saying is they are paying the price. So thank you so much, guys. You are welcome. So I want to say something very, very important in the next 5 to 10 minutes. Guys, please open your mind and listen to me. And I want to say this. The truth of the matter is Forex is a journey. Forex is not a destination. Forex is a journey, it's not a destination. Forex is like every other business. You need effort, you need intelligence, you need patience, you need to invest your time and your patience to be able to profit from Forex. Now, I'm going to be helping us correct a simple mindset because I realize that the reason why most of us fail in life is not because, or in trading or life, it's not because the real information are not available. Is because of one simple problem. It's coming from the law of value from our mind. A lot of us have a poor system of value. So I want to talk about this evening developing a wealthy value system. Developing a wealthy value system. You need to develop a wealthy value system for you to make money. You need to develop a wealthy value system, not just have the desire that you want to make money, you want to be rich. Your value system have to be in place. They have to be correct. Most of us are graduates, but we have a poor value system. Most of us go to churches, go to mosques, go to whatever in times of religion, but we have a poor value system. We have not learned to develop a wealthy value system to make money. See, if you chase money for the rest of your life, you will never catch it. Even if we give you 1,000 years, if you have a value system and your value system allows you to chase money, you will still never make it. You won't catch it. You know why? Because money was not designed to be chased. Money was designed to be attracted. In other words, if you build a good value system, you'll be able to attract money from where you are. It means that you are not disadvantaged because of your environment, because value has no respect for environment. You are not disadvantaged because of your skin. Value has no respect for color. I've seen white men talk to me every day with respect and with honor. And you know, if you look at Forex Factory, you discover like 1 point something million people has viewed me. If you Google MJ Young on the internet, Google will rank it as the second after like is it the man that's video or Michael Jackson Jr., something like that. But if you put it together, is the first in the ranking of Google. To tell you, people around the world have always been trying to check, what is this person doing? What am I trying to say? I'm saying that do not ever think that you are failing because of your skill. You are failing because of your value system. Don't think you are failing because of your environment. You are failing because of your value system. Nigeria is not responsible for your value system. It is you. So I want to say this very, very clear. We were born, our birth was without our choice. We never choose the womb to give birth to us. But our mind is a second womb that also gives birth to who we are in life. So there are two you in this life. The one that was giving birth from the womb of your mother, and that does not make destiny for you. So I can be born by a prostitute, by a poor parent, by farmers, by people who didn't even go to school. But the moment I give my mind, I can process my mind and conceive something and give birth to that thing actively. I can give birth to myself again. That is another phase of life. What am I saying? I'm trying to say that a lot of us have poor value system. What is your wealth value system for time? There are many of us that have been following this meeting. You can't even give 2 hours of your time. That is a poor value system. How do you expect to get much from something you never put much into? That is a very poor value system. Come to think about it. You want to make money overnight, you don't want to put effort. Did you graduate overnight? Tell me which of you went to school to study medicine and you wanted to become a medical doctor, and the first 1 week or 1 month or 3 lectures, 6 lectures you got in, your lecturer called you and said, Janet, how are you doing? Say, fine. Thank you so much for getting admission. Here's your certificate. You are now a medical doctor. I am very sure that if they give you a patient to operate, even your mother, you will not operate your mother. Even an animal, nobody will trust you with an animal. Trust me, if that is how people become medical doctors, even a native doctor, you will not become. The price must be paid, and you must have that as part of your value system. So in conclusion, what am I saying? I'm talking about the law of value, a wealthy value system. One of the key indicator that you have a wealthy value system is that you understand the law of price, that for every value, there is a price. Any man that does not price anything, that does not put a price on anything, does not truly have a wealthy value system. You must understand there is a price to this thing. They may be bringing it for you free, but there is a price for it. You have your part to play. It is true. So to make money in the Forex market, you won't just make it overnight. You need to develop your value system. Appreciate people. Part of your value system should be to appreciate. How many of you have chatted Mr. Tijani? Oh, thank you so much. Thank you so much. Hey, MJ, thank you so much. How many of you have commented on the group, on the Telegram? How many of you have put it on your status? It is a poor wealth value system. Your value system shows you are selfish. You don't want somebody else to partake in a free thing, and you want to make money. No, 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 no. No. So if you develop a wealthy value system, you'll be wealthy. So this is the story I'm going to tell you, and then we're going to conclude. It's very simple. Then Mr. Tijani will take over, and then we go on. Please just give me just this few minutes. It's very important, because no matter what we put in your hand, with a poor value system, you will still fail. We don't want to make sure that we are not just putting opportunities in the hands of rascals. We are not just putting opportunities in the hands of people that that will go and destroy their life. No, we want to mold a value system for you. There was this billionaire that wanted his child to inherit all his property. And while he came to age, he decided to look at the value system of his child. This guy, this boy, his son grew up, under a good atmosphere. There was no need for him to pray for food. There was no need for him to look out for money. The money was there. The father was a billionaire in dollars. And then the father called him and said to him, you will inherit everything I have, but there's something you need to do for me. The father said, go and make your first $1 million and come. Then I'm going to give you the document to everything I have. And the next day, the mother withdrew $1 million from her account and gave to the boy and said, go and give your dad. The boy brought it to the dad. And when he brought it to the dad in cash, the dad threw it inside the fire. And the boy was standing there looking. He didn't say anything. The mom was looking at the dad. $1 million bonds. And then the man said to the boy, go and get me $1 million of your own. The mom waited after 1 month and gave the boy another $1 million. And then the boy brought it to the father and said, Dad, look at it. I've gotten $1 million. And then the dad took it again and threw it inside the fire again. And the boy was standing there and looking at it, and it got burnt. And the dad said, go and get me $1 million. He was a billionaire in dollars. It's a life story. And then lastly, the boy decided to what is the meaning of this? And he got angry. The mom wanted giving him the next one. He said, no, it seems like Dad used to know if I'm giving. There are a lot of you. The reason you are not wealthy is that your value system is faulty. You want to be given everything for free. You don't want to work. You are too lazy to sit down and work. You want you are a slave to receiving. You are a slave to receiving. You don't want to put any effort. You want to be given everything. Everything you want to be given. No, it doesn't work like that. The young man left the country and went to work so hard. He could not make up after several months, he couldn't make up the $1 million. He made $100,000 after several months of his own. And he came back home because he could not work again much. And it gave the dad the $100,000 and told the dad, I'm sorry, I could not make up to $1 million. This is all I could make. I have worked for this, and this is all I could come up with. And he gave the dad the $100,000. Guess what, ladies and gentlemen? Do you know what the dad did? The dad threw it inside the fire. Wonderful, amazing. I'm talking about value, a wealth value system, developing one. The dad was trying to develop something in the guy and test something in the guy. When the dad threw it inside the fire, you know what the young man did? The young man dived into the fire, followed the $100,000 into the fire, and pulled it out with his hand. He didn't know when he did it. And then the dad said, now I know you worked for the money. What was that? Because he saw his labor being thrown into the fire, he was ready to enter the fire to save his hard work. Ladies and gentlemen, it is easy for you to listen to, for people to trivialize anything and you walk and pass it because you did not put work into it. If you put work into anything you make in life, it doesn't matter who talk down on it, you will value it. So the dad knew by that he worked for it. He was testing his wealth value system. How much do you value what you are given? How much do you value it? How can you value it when you put nothing into it? Ladies and gentlemen, I want to welcome you to today's teaching. You must, I repeat, you must destroy the entitlement mindset. Don't let people give you everything you have. It is too much. You are too lazy. At 30, you are still in your father's house. They are giving you food. and you are comfortable 25, they are giving you everything, you are comfortable. You are too lazy. You are too lazy. Trust me, you will. That is a bad value system. Okay, come back to Forex. You are going to need hard work. This is a journey you will take without your father. This is a journey you will take without your brother. This is a journey you are taking without your friends. You are going to have to put work into it, develop a wealth value system. You're going to put work into it. After the meeting, go back, spend 2-3 hours again. Put work into it. The next time somebody insults MJ Young, you are going to almost kill the person for it. The next time somebody insults Forex, you are going to almost kill the person for it. You know why? Because you are looking at the person throwing your hard work into the fire. He can't trivialize it. The young man told his father, to hell with your inheritance. I worked for this money. You don't know what I went through. Ladies and gentlemen, part of your value system, let me list 7 things you must train your mind to accept. 7 value system you must train your mind to accept. 7. Let me just list it and then we go on. Thank you so much for your patience, Mr. Tijani and others. Number 1, you must train your mind to recognize value. The mind is a system. The mind is a system with every possibility for making money. But the first thing is train the mind to recognize value. Many of you bypass this training because your mind has not been trained to recognize it. Many of you take it for granted because your mind has not been trained to recognize it. Your mind has been trained to recognize a job opportunity. So if you see a job offer for 50,000 and they're advertising it, you are going to travel for it because your mind was trained to recognize job as value. Train your mind to recognize value. Anywhere you see value, don't pass it. Train your mind. Number 2, train your mind to accept value. It is not everything your mind sees it accepts. You must force your mind to accept value. Tell your mind, see, I don't care if you are not comfortable, you don't understand. You must sit here and learn. Everything Mr. Tijani is saying and Sir MJ Young is saying, mind, sit and pay the price. Your head will tell you it is difficult, but tell your mind you can learn it. It is not impossible. MJ don't have 10 heads. He doesn't have 2 heads. Mr. Tijani don't have 3 heads. He was born by a woman. You too, you were born by a woman. Number 2, accept value. Train your mind to accept value. Number 3, train your mind to become value magnets. Beyond accepting value, let your mind be able to magnet value. Anywhere you know information is, let your mind be so valuable that and be conscious of value that it can attract it towards you. Number 4, train your mind to process value. Anytime you receive information, you meet men of value, you meet people, don't just recognize them, don't just accept them, don't just magnet them, process that value. Process it. Take out time to think. Take out time to go through it. Take out time. It's part of the price. It's a wealthy value system. Number 5, train your mind to engage value. What does that mean? The law of engagement. Let me tell you the truth. 10%, 5% of successful traders engage what they have had. Most of you don't engage it. I will tell you something. Anything you learn, we leave 90% of 70% of it will leave you after 24 hours if you don't practice it. And after 48 hours, 95% will leave you. After 72 hours, you might be struggling to place those things again. So you must engage the value. When you receive anything, go back, practice it. Give time to practicing it. Don't let the school system rob you of engagement where you recite things. No, sit on your system. We want to get something out of this. How many of you have engaged what you are listening? We told you open your account. I saw about 2, 3, 4 people that funded their account. Just today, they have made about 10% of their account. But most of you, you want to make money, yet you have not engaged that information. Number 6, do not just engage value, also train your mind to pursue value. Let your mind be able to pursue it. Be restless wherever you see value. Don't just walk like a sandboard. Let your mind be able to pursue it. Let your mind stay awake 2 hours, 3 hours pursuing value. Let your mind be on the internet, on YouTube pursuing value. Let your mind be here listening to Mr. Tijani to 12 o'clock pursuing value. Train your mind to pursue value. Some of you give 6 hours, 4 hours to Telemundo. Some of you give it to, what is the other one? That Indian channel again. Some of Z-Word. Because your mind was trained to give it to it. Now, train it to pursue value. And lastly, train your mind to pay the price for value. Number 7. Train your mind to pay the price for value. It's very important. Your mind should be able to pay the price for value. Ladies and gentlemen, thank you so much. My name is MJ Young, and I welcome you to day 4 of this teaching. Thank you so much. Mr. Tijani, you are welcome.
Thank you very much, sir. I'm blessed myself. So thank you very much once again. I equally took a note, and I will be sharing it in the group. That's a note from MJ Young. So in case we have anybody who did not capture what we have in there, I'll just like to share my screen. Mr. MJ, please, can you give me the host right?
I've made you the host. You said what?
The host right.
The what?
Okay. Host. Okay, thank you.
I've made you the host. I've made you the host.
All right. Today being the 4th day of the session is going to be like the meat, the bread and butter of the entire training, because at this very point we're going to be talking about a trading system that will blow your mind away and then possibly simplify what you think is difficult. But before I proceed, I would like to okay, sorry, I think I should be sharing what we had from our MJ Young the other time. So I'm going to share this message in the group. Okay, so for any reason you want to, whatever, I just did a caption and then I have it here. So note from MJ Young: train your mind to recognize value, train your mind to accept value, train your mind to become value magnet, and then train your mind to engage value, and then train your mind to pursue value. Not just that, train your mind to pay the price of value. This last point strike me more among all. He said, train your mind to pay the price of value. Sometimes when we say price of value, somebody will just go to how much are they talking about? No, it doesn't have to be financial. It could be your time, it could be your attention, it could be your discipline, it could be whatever you just have to sacrifice to get it. It could be your time of going out with friends and family to go and wine around, and then just pay the price. It could be your nights, sacrificing your sleep just to get understanding. It could be your time, like in the morning when you're supposed to be looking for some other things around. Come to Telegram and engage. TJ, please, you said something yesterday and I do not understand. Can you please explain? Then watch me ignore you. Just see, most importantly, learn to pay this price. I've had somebody that called me today and said he's coming to Lagos to come and spend 2 weeks, and then to learn just what we have discussed in the last 4 days, that he said it's not just enough to just be online. And those words are always very encouraging. So today I'm going to take you to the next class, but I stopped yesterday at divergence. So technically I will take you to the next slide, and then we're going to talk about oscillators, and then we continue from where we stopped yesterday. That's at divergence using the RSI principle. Okay, so I'm going to continue from where we stopped, like I said. So but before then, I will say basically what is a divergence. So this is market. Sorry, I think I'm supposed to use darker color. So this is a market. So this is the market. Now, this is the price zone. And then this is the oscillator zone, right? Oscillator zone. Now, this is it. When a market is going up like this, a time will come. Like for instance, the second movement, which is the middle, is often very long because this is the time that the entire world believe that the market is now going up. Why the market started going up at this point, nobody knew, because they were still like selling this market. So nobody is aware. So the very moment the market take out and create a new structure at this point, everybody is like, oh, this market is now going up, they join. So this middle move is often the longest. Now, by the time it happens that way, the market would have gotten towards the extreme zone, and then weakness will start setting in. Then the next move will be shorter. Now, if the next move is shorter, this shortness in the next move is indicative that the market is no longer interested in going further up. By so doing, the oscillator will be giving you sign that this market is tired. Now, this is what you're going to be having. Market was going up like this, came down, moved up, then all of a sudden it came like this, it couldn't make a new high. This is a divergence. So market could not make a new high, then oscillator could not make a new high, market has made a new high. Invariably, like I said, the extreme zone of the oscillator is always considered to be the 80, and then the resistance zone of the oscillator is also considered to be 65 zone, right? So let's put value to it, line to it, I mean. So it will be like this, and it will be like this. Then you're going to be looking for opportunity to sell. Now, when you want to sell the market, what do? You learn to, because we have said that markets will always make a move back to what? The trend line, right? Before continue going up. So let's say we want to put a trend line. We connect these two low together. We talked yesterday that how to connect a trend line is connecting the last two low in a bullish trend together, and connecting the last two high, which is supply, in a bearish trend together. So I want to connect this level and this level together to create my what? My trend line. So also in this case, to create a trend line, I'll connect this structure together. Now, once I do this connection, immediately market violate and close. Let's say the market does this. So all of a sudden, the market will now close below this level. When it does this close below this level, below the trend line, this is where we want to say the market has changed direction and is giving us a clue to sell this market. Then we start selling this market into the new low in such a way that we're going to be like, start expecting a new cycle in this market. Now, I'm sure you can understand this parameter. So also, if it is were to be in a downtrend, the oscillator will equally be going, let's say, okay, I cannot draw the anything here. I would like to put it a little bit up. So let's divide this section into two. Market is coming down, right? The third push is often very short. So the market is coming down like this. The oscillator made a very deep point, and the next move is it could not make a new low, whereas the market has made a new low. This is what we call a divergence. Now, the divergence occurring at the peak of the market is called classical, is called bearish divergence, because it's giving a sign that the market wants to go bearish, right? Bearish divergence. But before I proceed into this, whatever, let me just condition in the market where the momentum is not going the same direction as the price. Price is going up, momentum is going down. Price is going down, momentum is just making a new high, will not make a new low, whereas price has. So also, when market is making a new high, the momentum oscillator, which is now our RSI, could not make a new high, and therefore this is a divergence. Now, in this case, for a bearish divergence, this level will be the extreme, which is 20, and then this level will be what? The 35, which is the support. Like I said, the support on the RSI is often at the 35, while the resistance of the RSI is often at the 65. And this is how to differentiate between a bullish trend and a bearish trend. So, but like I said, every reversal in the market will be accompanied by one form of divergence or the other. However, not all divergence must lead to a reversal. This is why you need to apply the other technical confirming to, which is now the trend line. So the divergence is confirmed to be a reversal only after the trend line following the market is already violated. Let me take you to the chart this time around. So invariably, I'll take a screenshot of this point, this situation, and possibly put it in the group for us to be able to possibly work with later on. So like I said, the group will become our point of discussion. So you have any clue to anything I have said, which I have put in the group, please always draw my attention back to it. So tomorrow we might possibly meet this collision of divergence. Now, let's go to the chart and possibly see one or two things. I will use the EU as a case study. Okay, I can see whatever. Let's say Euro GBP as a case study. Now, let's say this Euro GBP as a case study, we can see that. Let me look for a market that has wonderful divergence today. Let me see GU. Okay, no. Let me look at UCAD. No. Okay. No. Let me look at gold. Perhaps we saw something like this on GCAD. Okay. Yes. Let's take a look at GCAD. Now, if you look at GCAD, market had just made a new high, right? Market had made a new high at this point, right? Market had made a high at this point and also a new high at this point. So connecting these two highs together gives us a higher structure. But if you take a look at the oscillator, in this case, it's just like this. But I'm not going to be respecting this kind of divergence because it did not penetrate into the extreme zone at this point. So I'm going to be looking at something that penetrates into the extreme zone. But let's take a look at the very basic origin here. Now, taking a look at this point, the market was making a new high. Oscillator was making a new high. Sorry, this thing is drawing back, so I will have to put this on hold. If for any reason you are working on a chart and the chart starts dragging back, there is this arrow on your chart here. Just click on it. So once you click on it, the chart will not drag you back. You can now scroll to whatever you want to scroll to. So invariably, let's take a look at basic template without any indicator applied to it apart from just what we have discussed. So this market was making a new low, but the RSI was making a new high. This is example of a key divergence that we talked about. Okay. Now, what we saw in this market is that the market had this kind of structure, isn't it? So we have that now. So once we have this, we now come to ask ourselves, this market is already giving us a divergence. So we want to buy when the market has confirmed that this divergence is real. What do? We now put a line to connect these two levels together. This is what we call the moment trend line. But sometimes I may have to do it like this and connect this structure together. So I'll just put this. So I'll connect this structure like this. I'll give a presumption that this is what we have, that this is the last eye and the last second to the last eye and the last eye. So once I connect together, immediately this candlestick close at this point, I start taking a buy in this market. Okay, I start taking a buy in this market, and then that settles a whole lot of things in this view. However, once you have come to this point of understanding the divergence principle, we can equally see it on the upside. So let me take a look at, maybe I can see something related like this on gold. Today gold made a new high, so let's say we can see white something gold. So I'll just look at gold. Now on gold market, I will just be expecting that this market may make a new high to this level. So if it does make this new high, so what am I going to be seeing? Market is making a new high, and then the oscillator, which is the RSI, could not make a new high. This will become a perfect divergence that I always look for. Why? Because the market has already made a move into the extreme zone, right? If the market has made a move into the extreme zone, then it signals the fact that there is no tendency for market to continue going further to the upside or in that regard, because it has reached the extreme zone. Now, if it has thus reached this extreme zone, now I'm going to look at how I will confirm this divergence so that I will not be selling the market, whereas the market is just having a plan to create a trap. So I'll connect this level and this level together, I will project it. So if the market gets to this level and I can see a candle close below this trend line, okay, once I can see a candle close below, this is how I am able to pick the exact stop within the market, and then I can say come down a little bit in this regards. But today, having understood the concept of divergence, support, resistance, trend line application, and the likes, then we need to simplify our view, so that most of the time the question is, do we have to draw trend line? Sometimes it could be very difficult, and then you do not know how to possibly whatever. You feel like there should be a easy way of doing this thing, and therefore this is the essence of today's class, where we're going to talk about our day trading system for a beginner without applying any element of ambiguity. Okay, so let's proceed. Why I want to proceed into today's class, I would like to tell you that there is what we call a trend. Trend, they say, is your friend. Always track trend and stick to it respectfully, believing that it is your friend. However, something we call trend often is a myth. So to some extent, to some literatures, also some educationists, trend does not really what we think they are. So let's go into our boardroom and then see to how we can look at it. What is a trend? Trend. I will just start like say trend. Trend has three basic components. Trends has three basic components. Full stop. The day you understand these three basic components, you are made, because you will be able to see when the trend is switching, when it is still in form, and when it is about to form. Okay, now the component number one is direction. Direction is component number one. Component number two is bias. Component number three is what I will call flow. Some people call it order flow, but I'm not going to be using any grammar here because grammar no dey pay bill. So the direction of the trend, the direction component of a trend is basically how the market is reacting to the mean. So the mean in this regards is what stands as moving average. Now, when we talk about mean in mathematics, we are talking about average, right? Mean, average. Have you forgotten? Average in our primary school, average equals to mean, Abi, and mean equals to addition of all data divided by the total number of data involved, right? That is it. So when you're looking at market going up like this, so you have so many lines to work with, and then sometimes when the market is about to make this pullback, you are confused whether the market is about to change direction or it's still in direction. So we now apply a mean. This mean helps to smoothing out the entire process of the market, and this is what we call the moving averages. This is where the moving averages derive their name, because they smoothing out, they average out the overall data within the market, putting together on some basic principle. Like for example, now you can create a mean for all the highs in the market. You can create a mean for all the lows in the market. You can create a mean for all the closes in the market. You can create a mean for all the opens in the market. And then when you are creating a mean, there must be a daily range reference, right? So this is what we call, this is where period now comes in. Now, when you're looking at direction, to make it a whole lot simple, I have tested so many things, and I have said I came up with 240 EMA. 240 exponential moving average is the most significant mean value in FS. It's not just only cash market or currency market. We're talking about FS, that is in this case standing for all the speculative markets put together. If you read some book, they will tell you 200 exponential moving average. When they tell you 200 exponential, then you put it on chart, you try to see exponential moving average. That is what we call the mean value in the market. So when you open your chart at any particular time, your job should possibly look at the direction of the market. The direction of the market in this case is the position the market is currently trading relative to the 240 moving average on that chart. If the market is trading above the 240 moving average, then we want to say the market is in a bullish direction. Let's put it in writing. If the market is trading above 240 EMA, please, you might want to test the difference between 240 and 200, but your findings will definitely be more or less supporting mine, because this is what I have done for like almost 3 years in a row, and I discovered that I just have to conceptualize, adopt this 240 EMA. When you get to the intermediate class, I'm going to tell you about how to convert moving average from higher time frame to the lower time frame. But that discussion is going to be beyond the scope of this class. Then you're going to know more when we get to the intermediate class. Now, the market is trading, when the market is trading above the 240 EMA, then the direction is what? Is bullish. Bam, foolish, finish. So the next thing is, when market is trading below 240 EMA, comma, is what? Bearish. Bam, bam. As simple as ABC. How do we put this 240 EMA on the chart? How does it even look like? Let's take a look at it. I'm going to create a possible blank chart and then put this into, let me take this snapshot and send it to the group so that it does not become like we documented for all of us here. So I'm just going to put this one also in the group. Now let's go into a basic chart. Fees. So this is a blank chart indicating gold market, right? So I want to add 240 moving average to this chart. Come to the top. How do you add indicator to your chart? At the very top, there is what we call file. Click on file, right? Okay, I think click on, wait, at this very point, you will have this file, but below this file, there is what we call navigation, right? So under this navigation, click on this navigation. When you click on navigation, you will see where they wrote indicator. Click on this box, open the indicator up. Then you will see where they wrote trend. You can see that the moving average is indicator within the trend folder. So click the trend folder, open it up. Then you will see a moving average. You can see the moving average is placed inside the trend folder, right? So meaning they are trend smoother. Now, so you like 240 EMA, choose whatever color that you like. Let me say I want to use this color. Then let me say I prefer to use this thickness. But in this case, I'm going to be placing it on typical price, which is HLC divided by 3. Then I'm going to click OK. Now, if you look at this chart, technically, something should strike your imagination. The market often bounces away from the 240 EMA anytime you pull back. So let's zoom out this chart. Let's zoom it out this chart. Then you will see what I'm trying to say. Then I'm going to remove digital whatever there. So you agree with me that the market was at a time as at this point. Now, when the market started going down at this point, you can see move back, then at a point it grew up and violate at this point, and then it started going up, right? So if you have followed this 240 MA only on this time frame, 30-minute time frame, you possibly would have bought gold at this point and still be holding it. So when gold was doing all this movement to the downside, you are not perturbed, you are not moved, you are not going to likely react to the market, because you want to say the market is still trading below its main value. and that is the direction of the market. So let's say you want to look at the weekly cycle, which is going to be on a 4-hour, then you come to the 4-hour and put it like this, then you will possibly say, okay, as at this point, so let's just take a look at this. You'll see that at the time the market violated this structure, the market started going down. You can see all the structures. The market will often come back. Sometimes there's nothing like absolute, but around it, the market will often create a chance. Let me say, now we are going to be looking at gold come down. If you watch my weekly and outlook on weekend, on Saturday, you're going to see something like this, and the market will continue going down. Okay, but nevertheless, what we're going to be seeing technically is a need to move. Now, this market has violated this 240 EMA, right? So what you're going to be expecting is a pullback to the 240 EMA, like you want to project to 40 EMA. So market will come back to the 240 and continue. So this 240 EMA possibly can be considered to be dynamic support and resistance that is trailing the market. Hence, we agree up to adopt 240 EMA as our dynamic support and resistance, believing that when the market is trading above it, market will often continue to go higher. At any time the market is making a pullback, the pullback often end around the 240 EMA. You understand? At any time the market makes a pullback and close above the 240 EMA, you are expected to wait for market to retrace back to 240 EMA and then start buying, not to be trading against it. So, paraventure, you are looking at the market and you want to place a buy. Let's say you want to place a buy at this point, right? And the 240 EMA is going to be at this point, and you are looking at profit at this point. This is a bad trade because the 240 EMA will be considered to be a barrier that can reject your market, that will hinder this profit from being achieved, right? So you want to trade, if you want to trade against 240 EMA, make sure that your profit is expected to be taken before you get to the 240 EMA, something like this. Like you are buying a profit must be before the 240 EMA, because you should be having it at the back of your mind going forward that 240 EMA is a dynamic barriers guiding the market. Okay, that settles that. So now, when you open your chart, let's say I'm opening my chart on the intraday perspective, let's say on the basic template like this. Now, taking a look at this, this is 240 EMA. If I go to daily time frame, you're going to see some way the market respects the 240 EMA, hold above it, and then like at this point, hold above it and then bounce, and then hold above it here, bounce. Okay, now violating it, possibly went down the more, but at this point, violate it back and then pull back and then continue going up, right? And that is how the 240 EMA play some integral role in your trading analysis. When you come to the intermediate class, I'm going to be possibly extending discussion on 240 EMA, telling you how we came about this number in the Forex market. Okay, but for now, let's just see how we can apply it to create a trade intraday trading system. So when you open it's either the market decide to come up, trap the market at this point, and then come down like this, whereas the 240 EMA will now continue this way, because you can also project the 240 EMA into the future. Like as at this point, you can project it like this, right? So you expect the market to come back to this level. So a market movement from year to year is a counter trade, right? Because it is trading against the direction of the market. But the reason why you are going to be taking this trade was best discussed under the divergence principle, that when the market make a new high, RSI could not make a new high, position to trade the failure of the top side. Market will often create a trap at this point. Then how do you confirm the market as want to go down? You put your moment trend line, which is your trend line, and immediately a candle close below that trend line, then you are good to go to take the trade, and then you take it back to the position where you have the 240 EMA as confluence, then you continue to trade along the line in the market. I'm sure that clarified things. So let's take a look at a market that was selling today. So I will look at something like Euro CHF. Let me look at Euro CHF. Let's go to the 4-hour perspective. Then we can see some, okay, it is far away. Okay, now we can see some market move. Okay, it's far away. Let's go to intraday. We can see some market move. So I want to see a market that reacted to the 240 EMA perfectly. Okay, so let's take a look at this market. Control Y. So at this point, the market changed direction, then you start buying. Market came here, bounce off, and you keep holding the buy. But at this point, it changed direction, then you keep selling. So why the market is still level? Now, this is what we're going to be expecting in this market. Why are we going to be expecting any funny move in this market? From this point to this point, from this point, at this point to this point, market has done what we call a divergence, right? So if market had done a divergence, let's see, I think in the chat box. If you can hear me, put 1 in the chat box. 1. All right. Thank you very much. That's what I want to confirm. Market has done a divergence at this point, meaning that the chance that this market will continue to go down is very slim. So obviously, what I'm going to be expecting in this market is like possibilities that the market can come a little bit down like this. When it comes down, then there will be a trap, right? If there's going to be a trap, I'm going to be using this last 2 structure here as daily a candle close above this level, I'm going to be taking a buy to the upside, and that settles a whole lot of things. Why am I taking this buy? Because I can see divergence. So this divergence helped me to take trade, but when I'm taking this trade, I'm going to be putting my targets before the 240 EMA. So my target is going to be around this point where the 240 EMA will become a hit. So by the time the market now gave me a market rise above the 240 EMA, then I can assume that the overall trend has changed and I cannot start holding it continuously. But this point, the market tells me I should prepare for a buy. Abi? But if I'm buying at this point, I will only do it when the market violates the trend line that is guiding this flow. So I'm still expecting this market will come down and possibly, let's say you draw this arrow, this one will come a little bit down and then bounce off it. This is going to be what I should be expecting. This divergence principle is the one telling me that this market flow from this point is coming to an end. Now, let's take a look at the upside. When the market was moving from year to year, right? So if you take a move into this level, this is what we had, Abi, at this point. Then the market made a move into this level. Okay, this is the top side of this market, right? So let's remove this. So I'm removing this. You can see that the market was making a new high. Now take a look at the RSI. Right? You can see that it's dropping, meaning there's a divergence. So how do you take this trade? I'll connect. This is what I have here. You need to watch it closely. Like watch it closely. I'm going to be sharing this trading drawing tool in the group so that you should be able to draw your tool also just like I'm drawing it and then see it perfectly like I am seeing it. So at the point that the market closed below the trend line after divergence has been cited, this is where you start looking for opportunity to sell. Mind you, coincidentally, the 240 EMA was violated around that point. So this is where you start selling from. And this O will become your profit in your account. While the market is still trading below the 240, you start looking for opportunity to keep selling. Mind you, while the market was dropping, there was no divergence telling us, giving us a warning that the market should not continue to drop again. But the first time the market is giving us warning is at this point, after this low was formed, meaning that this first divergence leg, Just as we put trend line there, you can also expect this kind of move. So the reason why I'm going to be expecting a possible drop into this market, and then I can possibly accept this as my trend line. And then you can see that I'm not struggling to put the trend line from this very high. As I'm not struggling to put this trend line at this very high, then I was able to, I'm just expecting this pullback so that this trend line can be very close to the market, and then they can give me a perfect low risk entry in the market. You get? Now, let's take a look at this. When you, let me look at Euro GBP today. I think I have a perfect situation in the Euro GBP market as far as today is concerned, because the market reversed from the base. Now, let me look at this from this point of view. Now, at this point, the market was coming down, right? Then this is what we have here, right? Coming down. This is the extreme zone. And then this is like, if you draw it downward, this is what you're going to have at this point. Like, and then if you draw this one down, this is what you have at this point. So this market was rising on the higher side, but the price was whatever here. So what do I do to take the trade? I will just place a line. This is what I see here, like this. You need to track the market last two move, then you connect it. Immediately this candle close, this is where you take the buy into the upside. Okay, so this is as you're taking this buy into this upside, I think you can get this clip. If you take a look, I took this trade in the morning, and then the thing got profit around this point later in the day, and then that's perfect my whole view on this trade. So when you're looking at divergence, you should equally look at confirming that the market is going to reverse. The presence of divergence in the market is not a final say that the market is going to reverse. Now, let's take a look. So I'm going to load this on the very way. Like I'll say, when you open the chart, the 240 EMA is always very obvious. Me, I don't joke with it anyway. So when this is intraday point of view. When I open the chart today, the direction of the market is basically bearish, right? Because the market is making a new low. So as of today, this is where the market opened, right? As of today, this is where it opens. And then when the market made this high, then I'm looking for a place to sell, right? Possibility is that I will be looking at, this is the last support that was formed. So I was waiting for this market to come to this level, but it never did come to that level. So what I do was to place a sell stop, since I am expecting a drop, right, in this market. So I will place a sell stop, and the sell stop got triggered at this point with a view that it should continue going lower. But by the time it came lower in the afternoon, it formed this low, and I can see this divergence obviously in this chart. Then the next thing is I should take my exit and then start preparing for a buy. If we see a candlestick, this candlestick eventually open like this, rejecting this level, giving us a bullish bias candlestick here, which call for buy. And when you're doing this buy, your stop loss is going to be the last low created. Sometimes I just look at my bed and I say the stop loss value, which is called the SF value of 15 pips, is going to be applied. Then the TP of 20 pips, 30 to 27 pips will be applied. Then that settles the whole trade around this point, and that is it. Let me see if this trade is run on this thing, because this is not my main account. So let's see. Okay, this is just okay. I opened this account before the beginning of this session, so I would have showed you that trade and what became of it. So I'm sure you get this logic. Now tomorrow, when the market opens, now the market possibly is having a bearish direction because it's trading below. This is 240, and this is where the market is currently trading. Technicality is that the market should not, for any reason, this is a bullish bias market, right? How do you see a bias market? If you take a look at today's candlestick, it closed bullish up, and then it closed above the equilibrium line. This is the equilibrium line here. This is a bullish bias market. So for me, I will be looking at buying this market, but if I'm going to buy this market, only if the 240 EMA is violated, because at this point the market is too close to 240 EMA. So how do I buy this market? I will wait for the market to go up, come back for a retest, then I will buy the bounce of the 240 EMA, in line with the bias that is currently printing in the market, if the direction follows. Now, this is it. I talked about 3 components of a trend: direction, bias, and flow. The flow obviously is bearish, right? Market is still doing lower low. That is condition number 1. We say flow is bullish, bearish. Then direction is what? Is bullish. Is bearish, Then bias is what? Is bullish, because it closed above the equilibrium. So I should be looking for a sell, but I'm not selling this market. Why? The reason why I'm not selling this market is because I can see from the very base low point here that we had a violation of this level after this thing here. So the worst this market will do is to pull back to this level and continue to go up into the 240 EMA. And if it continues to go up here, this is where I'm going to become very happy, because the direction and the bias will now be equal to the same thing. Then I want to buy a pullback to it and then continue to hold this market to the upside. Paraversion maybe into this level. So I'm not going to buy this market at this very point, but if it does make a move into this level and form a base at this point, then I will buy here. I'll put my TP1 here. If the market takes the TP1 and go up, I will wait for you to come back. And if it does come back, I will add another buy. Because by the time the market values the 240 EMA, I am going to be changing my direction in the market. Then I will now agree that the market is biased to the bullish side. Direction is now bullish side. I will now, like for example, if I want to buy at this point, I'm going to use 1/3 of my normal lot size. But if the market values the 240 EMA, I'm going to use 2/3 of my normal lot size. So let's say this trade is still running. Then by the time I get to this level, I'm now having full lot size in that market, right? But invariably, if I'm going to be buying at this point, my TP should respect the next technical barrier. Do not set your TP from the dream city. Do not say it has to be 50 pips. The question is, take what the market is practically and possible to deliver. Do not over expect from the market, whereas you have a hindrance against the move. Always understand the position of the market relative to the current flow in the market. So now look at this structure. Yesterday, when I was creating support and resistance, I think you will all got it clear, right? But now this is where you now apply the practical aspect. This is what happened in the UCAD market today. The market obviously was bullish, right? Going up. So we all should be expecting to buy here, right? Maybe when the market eventually come down into this zone. But what happened? The market first went down, did all it can do, and onto this market. Now, this market has possibly given us a tail on the daily time frame. I always have my daily time frame and my weekly time frame to look to just have a peep of what is happening on the higher time frame, so that I don't get lost looking at the intraday perspective. So in this case, this market at this point haven't gotten to this level, took sellers into this market, then trap them up. So this is obviously a trap, and the market is still having a bullish bias, a bullish direction. Now, as at the time the market opened at this point, obviously is trading above the 240 EMA. So you want to be buying around the 240 EMA based on what we see, that the market will buy around the 240 EMA. But instead of buying, the market went to trap below it and then close back up, making sure that the people that bought here, their stop loss got triggered, taken out in the market before the market came back. After the trap has been set, then maybe if you are in the market as at the time the market closed back above level, when this market was making a pullback, this is where you take your buy, and then you will still be in this buy. Now you are going to be buying only when the market is obviously confirmed to be trading above the 240 EMA, and your job is to take trade very close to around the 240 EMA. Trade you take around the 240 EMA often have small stop loss, so that your reward can be big in that kind of market. You don't want to take a trade that is far away from 240 EMA and therefore start thinking of where your stop loss will be. Let me say you are taking a buy order at this 240 EMA, right? let's say I'm taking a buy, but before I take a buy, I want to see a candle pattern formation. I could see none at this point. So this buy will not be taken if I'm watching this chart, right? So, but the time the market come back and close here, let me say, as the time I'm looking at this level, at this point, I'm taking a buy here. If I'm going to take a buy here, my stop loss is just going to be few pips below the 240 EMA at this point. Then I will be expecting, like, of course, this level, this one says I should use 32 pips, but I will not use up to 32 pips. I will just use like between here and here, 15 pips. And then I will be holding this trade with a view that if this market come back and close below the 240 EMA, then the trade has changed direction. So if the trend has changed direction, why should I be keeping my stop loss here when I know that the market is trading has changed direction? I will now wait for the trade to hit. So the 240 EMA position in the market helps you to set your stop loss few pips below it, believing that if this stop loss got triggered, then the market has changed direction. You do not need to place stop loss thinking that it has to be 30 pips, it has to be 20 pips. Even when 10 pips is okay. Just few pips below the 240 EMA, believing that if the market come back below the 240 EMA, the direction has changed. But while the market is trading above the 240 EMA, direction is still bullish. Then you are holding your buy in that kind of market. So invariably, let's say the worst thing this market can do, like now, I'm not going to be trading because I said my trading time period is between the 8 a.m. and 10 a.m. or 1 a.m. and 1 p.m. and 3 p.m. in the afternoon. This is the London market time zone, and this is the New York market time zone. These are what we call our brink. And I told you, do not take trade between the hour of 10 and 12 in the night. This is called the dead gap period, where manipulation is often very present on the chart, where spread widening is very rampant. So you don't want to take a trade around this period of the day. Otherwise, you're going to become a victim of manipulations in the market. This is the optimal period when the banks trade, and this is when you should be looking at trading. Like now, I often see people that will send me charts 2 a.m. and tell me, TJ, what do you think? As if I should not be sleeping. I have said, do not look into the market. Enjoy your sleep. Nigeria is blessed, tremendously blessed naturally by we having the best time zone to the best business you should be doing in this country. That is trading forex. Behind us, possibly the London session is their whole midnight. It is not comfortable or convenient for them, but they just coming into the market. So I want to be buying this market at this point. So if the market come back to the 240 EMA, I will be buying. Like I said, keep trade around the 240. Right? I'll buy here. Then if I'm buying here, my stop loss is going to be here. Very small, 10 pips. Then I'll be expecting a new high. So, like I said, 3 components of the market, of the trend: direction, flow, and bias. We are talking about direction today. And then the other 2 components will only be discussed during the intermediate class because it's going to be beyond the scope of this training, in line with what we're going to be taught. So now, technically, when you open your charts, just open any charts. Let's say even, let me look for string charts. Let's look for a very string chart. Let's look at crude oil. Crude oil. Let's load crude oil and see what we should be expecting in this market. Crude oil dropped or what? Okay, still loading. Okay. Sorry, yesterday I talked about crude oil market, right? If you were in that class yesterday and you saw that you were in that class, you should possibly see what we discussed in that video. This has become materialized. Crude oil dropped today, and crude oil should drop to 55 zone. Okay, but how do we come about that 55 zone drop from here? Okay, this is UK oil. Let's look at crude oil. Crude oil. I like crude oil because that is what my country believe in. Okay, so this is it. Now, if you go to this weekly perspective, you see that the market is having a reaction at this point, right? If it does have a reaction at this point, and then this market should continue to drop. This market will keep dropping, not that it should continue. There are some things that happens in the market that you cannot change. This market will drop like this into testing the 240 EMA again, around the 55 the $55 per barrel. From year to year is 2,000 pips. But the market will keep doing it up and down, up and down, up and down, up and down until you get there. And me and you will still be here, even while we have this information at our hand, free of charge. All you need to do, open your account and execute the trade and walk away. Now, let's say we are looking at this crude oil market. Today, when the market opened as a bullish bias, right? At this point. So open at a bullish bias, but when the market come back to the 240 EMA, we did a buy, right? In the morning. So this is where we did a buy, and the buy became profits towards this high point, right? Now, in the afternoon, when this market did close above this level, below this level, the worst this market will do is come back and drop. So the next sell is going to be the retest of the 240 EMA around this point. So you project the 240 EMA and you put your sell limit. This is how to use it, sell limit, believing that the market direction has changed. If the market direction has changed, just as the market came to this level and bounced, so also the market will come to this level and drop. You do not need a calculator for that. Just looking at the market and then come up with your understanding of what the decision is going to be about. Now, if you take a look at this level, if I want to put a trend line on this chart, what I will do is that I will be looking at a trend like this. Like, is that also? So when this market came back to this level this morning, it formed a coincidence with the 240 EMA and the trend line, and then this bounce. So you can possibly place a buy limit around this level in the morning, and then you will realize this profit towards in the afternoon. But let's say by the time the market now did this, as the time the market did this, then your next job is what next? You should be able to create what next situation in the market, that okay, the market will come back to the 240 EMA around this zone, protect it, put your sell limit at this point, and then when the market comes to this level, then you sell. And when it does this, then it will complete a cycle, and then the cycle, everything repeat again. The next thing is that it will continue, it will go up again, maybe by this time into this support zone, and then sell again, and the whole thing will continue until you get to the 55 zone. 2,000 pips will be achieved in this kind of slow motion move. Go up small, drop, go up small, drop, go up small, drop. If you load any chart, maybe a card, let's look at a card. A card possibly as at the time the market was trading up, down, right? As at the afternoon, the market was trading below the 240 EMA at this point. Let's say you took a sell after this kind of form a pin bar, you would have made profit here, Abi. Now, by the time you have made profit, let's say the market, because if you do your support and resistance mapping, you possibly will put a line here, looking at this level here. Now, by the time you came to this level and you make profit to this level, when the market snapped back, you were not there. But the question is, if the market has come up and given us a bullish direction, what do you do next? The next thing you want to do is you want to project the 240 EMA into the future, like as it is now, projecting it, right? So technicalities that the market can come like this and continue going up, or come to the 240 EMA and continue going up. So what do you want to do? I want to create what I will call a confluence zone, but confluencing is a little bit above the scope of this training. So the level at this point, I will project it here. Of course, if you see me project it to the side like this is previous support, I mean resistance at this point. Resistance at this point. These are two level tested, and then it will become a support at this point. So if you project the 240 EMA, it will be a confluence at this point. So market should come to this level like this tomorrow, and then you buy around this zone. So this is where you put your buy limit. You buy here. Why are you not buying here? Because you know that the market will often make a pullback to the previous key level that has been violated and towards the 240 EMA. So the two of them are coming together at the same point. So this is where you're going to be putting your buy. You knew you are going to buy because the market has changed direction to the bullish phase, isn't it? So this makes your job very easy. So the question of, okay, now I know the direction, market is trading above this thing. Where should I buy? Just look for where the market with the last key level is, when you are drawing your support and resistance. Like I said, when you are looking at support and resistance, always look for major level that are tested more than once, upside, level that are tested more than once, downside, or level that creates structural supply, demand, and structural supply. Those are the 4 levels you want to be seeing. So your eye should be trained to magnetize these structures and identify them wherever they are in the market. So immediately the market has done these 2 structure here. So just put a line there that, okay, oh, this level here is a major resistance because it forms like a M top here. So you project it. So if you project it, this is a key level. So 240 EMA should be projected also. Project it. So this is where you are looking at, right? So you create a structural plan to create a belief system for the market move in this direction. Then you place your buy limit here. Buy limit is taking a buy order in the future at a price below the current market price, right? That settles that. So you are going to be placing a buy limit here. Stop loss, small pips. Once you take a trade around the 240 EMA, your stop loss should not be more than 20 pips for any market. So because if the market takes that stop loss, the direction of the market has changed. You don't start guessing it again. The next thing is just a pullback and continuation. You don't want to be holding a trade that has changed direction and believing that the stop loss should be here. So people always come up with this ideology that let your market breathe. There is something like a breathing space. There is something between understanding the real level of breathing. Now, this is it. When you understand your level of invalidation, it is often around the 240 EMA. So when you take trade around the 240 EMA, this is where your patience factor is. You will not take it here. You will not take it here. You will wait patiently to take it here. And at what point will this happen? In the London session, between the hour of 8 and 10 or 1 and 2, 1 and 3 in the afternoon. So just go to bed, come tomorrow morning, come and look for this trade around this level. Then when you come to this level, take a buy if you see a candle pattern formation for entry. Clear? Now let's take a look at a little bit another market. Let's say even GU. GU is not a bad one. So if you take a look at GU, I will say GU has a bullish direction because this is 240 EMA, right? So my job is possible to see a market move like this. I want to, like I said, I want to take trade around the 240 EMA. Abi, like this. So when this market comes like this, let's say like this, the market might just continue to range, right? Like this. In the London session, this is because I always want to trade in the London session. This line you see on my chart is the end of Asian. So everything here is London. So this is around where I want to trade. You will never see me take a trade within this zone because this is Asian. So when it comes to this level, I'll take a buy tomorrow into the up level. But if I'm taking a buy into the up level, where will my TP be? Here, because this is where my major resistance is. This is my supply because a new low was created at this point. So this supply level is going to be my next barrier. So if I'm taking a buy here, my TP is going to be here. And that settles a whole lot of things. Very simple. But if I'm taking a buy at this point, my stop loss is just going to be like 10 to 15 pips below this 240 EMA. This is going to be my risk and this is going to be my reward. Right? I created some chart this morning. If you take a look at USD JPY on the 4-hour perspective, then this drop will not be too funny to you. Take a look at it. Okay, market was like, this is a previous, okay, I think we did this yesterday, that this market will do like this and then we can see a new low, right? Let me see if I think I sent a chart like this to our boss this morning. Sorry. Let me see if I can still track that chart. This is the chart, right? That we're going to be dropping this market today and then into a new low. And I think I discussed this yesterday in the class also. So this is not something that you should be finding difficult. Now that the market has just done this, now, as it is now, let's say on the intraday phase, I will go to the lower time frame. Now, the market has just dropped below this level. So this is where I was supposed to like be looking at a possible sell. This is the last low, and this is the 240 EMA. At this point, this is where the market changed direction. So the next thing the market will do tomorrow is this. I want to project the 240 EMA into the future because as the market is going, it will equally go in the same as it is going down. So let's say this level. So the worst thing this market will do is just sluggishly go whatever. Then the 240 EMA will catch up at this point. So if it does catch up at this point, right? So sometimes I want to look for confluence, and how is confluence? Like this is a support level here, or let me say a demand violated. I will project it like this. So I have violated at this point, support at this point, but becoming resistant at this point. Then 240 EMA is equally coming close. So I want to take trade around the 240 EMA. So if I'm selling at this point, my stop loss is going to be very tight, not more than 10 pips. Then my TP will be like something like 30 pips or 40 pips in this market. That is how to track a very good risk to reward ratio, waiting for the market. So immediately you open the chart, irrespective of the time frame, just look at the 240 EMA, look at the current market price, then just run your conclusion on that. If a market is above, like this now market is below, this is bearish market. The next thing is you want to project the 240 EMA into the future. How? Right? That is it. You have just projected it. Then you want to look at the previous support that has been violated at this point. Right? That's it. So you are looking at something like this. That's it. So I'm going to be placing a sell limit at this point. Stop loss like, yeah, not much, like 10 pips away. And that's it. So believing that if this market come back and close and take my stop loss out, what happens? Direction has changed. So I will only wait for a pullback and then continue to buy. I do not need to put my stop loss here, because this level is broken, which is 240 EMA. The market has changed direction. Don't be forcing yourself to holding it. Like now, when I was buying this market, let's say I bought this market at this point when it was going up, my stop loss is going to be here. Abi, now it made this candle close and take the stop loss out. Full body candle like this, closed and take stop loss out. I should be selling this market at this point, because nothing is. So I should have recovered my loss in this case. If you are now keeping your stop loss at this point, you are just wasting pips, because this stop loss will still be triggered. Right? Immediately the market shifts, know it. This is how you track it based on the position of the market relative to the 240 EMA. The 240 EMA is the most important line you must always pay attention to when you are looking at intraday trading perspective. So you look to be buying above it and selling below it, and then you can equally use the projection of the 240 EMA to create your trading plan in line with where the market should come back to in future for you to now keep trading in the new direction, so that you can have a low risk entry. This market has told you to sell, Abi. Fine, you can sell here, but you stand a chance of suffering a pullback into this 240 EMA before the market continues to drop. Right? So you don't want to risk that kind of thing. So usually in the market in the Asian is often a pullback session back into the 240 EMA, and then you sell in the London around this point. You will need to backtest this to understand the beauty of what I'm passing to you here today. Now, taking a look further, you possibly can say, okay, this market is like, okay, let's go to another market. So if you go to another market, let's say cards, anything you like, just suggest. You can suggest a market for me to take a look into. I need to shed more light on how to identify 240 EMA. It's not like identify, you put it. This is it on my chart. I just put it on my chart. You would also create it on your own chart. Go to navigation, go to 240 EMA. I mean, moving average, put 240, put this structure and click OK. Then it is on your chart already. So as you are scrolling, it's on your chart. So you keep moving with your chart, right? So if it keep moving with your chart, then you need to keep trading wherever here, around it like that. Now, this market is still bearish, right? So if this market is still bearish, then we expect a new low, right? So the new low we are expecting is going to be like a hit of this level. So what do you do here? How do you take this trade? How do you take this trade? You wait for the market to do what? To do a pullback, right? So let's say the market is here. Now, like it could do this and come like this. Why I'm looking at this level is beyond the scope of this class, then I will not be able to explain it. So the reason why I just want to limit the discussion on trade and 240 EMA. But on this 240 EMA, you see that the market is below the 240 EMA, which is bearish. The best place to sell is around the equilibrium line, which is what I have here at 1.80 whatever, with a view that the market should come and make a new low at this point. Now, in this case, you will not be waiting for the market to come to this 240 because it's too far away. Why should I be waiting for this market when it's for like 40 pips, when my target on this trade is going to be like 30 pips? Of course, I should be taking caution. Now, when the market is far away from 240 EMA like this, you lose the next closer available key levels in the market. And that is where understanding the bias and the flow becomes necessary. In this case, the market is still flowing down, right? So if the market is still flowing down, you need to also respect that flow. And the market is having a bearish direction, you need to respect that direction. The market has a bearish bias, you need to respect that bias. So we are taking this trade around this safe level at this point here for a new low to this level. This is going to be like 30 pips drop. Why are we looking at sell? Because direction obviously is bearish. Market is trading below the 240 EMA. Okay, you might want to look at this currency pair, AUD, NZD. Whichever the currency pair you look at, immediately you open it, the market should tell you the position of the market relative. So if the market is further away from the 240 EMA, what you want to look for is the next available barrier. In this case, this is where 55 EMA comes in, but I'm not going to talk about 55 EMA so that the whole thing will not look complex, like which of the two are we even looking at. So just for now, pay attention to 240 EMA on your chart. If you take a look at this chart, why the market was trading above 240 EMA, you can see those bands, you can see those bands, you can see those bands, you can see this violation. Why this market violates this level here on this candle? If you are holding a buy with the hope that it will come back, you are not supposed to be in this class, or you should consider that this class is not necessary any longer, because immediately the market closed below the 240 EMA, this is when the trend shifts, and so you shouldn't be like looking at holding this market at below this level. This is where you need to exit the market. So if you are taking a buy here, let's say you took a back here, your stop loss should be few pips, 5 to 10 pips below, and immediately is taken out, you reverse the trade. Now, this is position where we put SAR instead of SL. This is SL, and then this is SAR. Stop loss and stop and reverse. I will talk about stop and reverse and how to apply it on our trading in the intermediate class, and then we can see it practical. But for now, let's just understand the position of the market relative to 240 EMA in line with direction in the market, and that settles a whole lot of things. Now, this market possibly, if you look at it as what we call a drop to the downside, so I'll be expecting like something like this, in such a way that we will now have a divergence. This divergence will be very, very obvious around this level. So let's say I am going to be expecting something like this, right? So this is going to be my divergence. This is the extreme, and then the market can bounce back up. Right, I'm sure that is clear, divergence. Now, if you look at this divergence and you want to trade it, all you need to do, if this market comes this high before dropping, then you connect these two eyes together. Immediately a candlestick close above this eye, then you buy this market, because divergence indicates you should buy when the trend line is violated. Then you quickly take a position to buy from the very low instead of waiting for the market to come to the 240 EMA before selling. So when you are buying the market against the 240 EMA, then the 240 EMA will become your target. So this is going to be our target one. So there's a way you can project the 240 EMA on your chart by just using a line to connect it and project it to the future. So by the time you're looking at market, come back to it. So that it will become your target one. Don't always put TP behind the 240 EMA, believing that the market must violate it. The 240 EMA is often a barrier. Learn to take your profit before it is achieved. Then when you open your chart to any time frame, I always look at 30 minutes for intraday, 4 hours for weekly cycle, and daily time frame for monthly cycle. Then you want to respect orderliness in that regards. Let's go to our notes and then look at this. Now, I'm sure I've talked about this, so I will continue with our slideshow. Now, custom from this slide. Now, our ratio analysis on RSI indicate that bullish is at support is at 35 for a bullish phase, and extreme is going to be 85. We've talked about this. Then we've talked about divergence also. We've talked about the simple divergence and how we can look at it is critically. Then we talked about the ED. Okay, I didn't talk about ED divergence. Okay, ED divergence is another form of divergence that I will call a trend continuation divergence. So let's take a look at it, how to even look at it. Let's say, for instance, the market has a low at this point, a high at this point, and then it gave us a divergence at this point. Look at it. RSI is making a new high. Price has done new. So this is a bullish divergence because it indicates that the market wants to turn bullish. So when the market now turn bullish, the market now did this, start going sideways. So by the time the market now did this, the price could not make a new high, but the RSI has made a new high. So the market has made the RSI has made so much effort as being in the market, but there is no result. When effort become wasted in the market, then the market is not interested in going that direction. Then you want to look for a sell opportunity in line with the existing flow that was in the market before the divergence that causes it to reverse up. So you now say this market is a pullback. So like now, this market has a divergence at the top here, but when it was now coming down at this point, it started making a sideways market move in such a way that the market could not make a new low, but the price or oscillator has made a new low, and therefore this is what we call a hidden divergence. Hidden divergence always tell us that we should look for opportunity to continue in the old direction of the market. More than often, when you're looking at a hidden divergence, why I'm not always talking about it, because 240 EMA we always guide as key level to watch out for the buy. In this case, 240 EMA will equally guide you to watch you for this buy. So when you understand the direction of the market, the hidden divergence technically will not be too much something you have to pay attention to, so that you don't have to be watching at too many things at the same time, therefore breeding confusion. But technically, the only time you need to watch out for divergence that you want to see technically is when the market has made an extreme push into the upper range of the RSI, and then divergence is now occurring. That divergence must be put into consideration in the market, because it's often signaling a reversal of that trend. And when you see a divergence in the market, your job is not to add to the position. Your job is to be anticipating a reversal. Therefore, the next thing you want to do is to add trend line. So when the market valued this trend line, it came back for a test, and then you see, boom, to the upside. Let me show you this on this chart. So if you take a look at the chart for the hidden divergence principle, you can possibly say, okay, at this point, I should see a hidden divergence. Let's look at it. Okay, now taking a look at this point, the market has a high at this point, right? Isn't it? Now, at this point, the market made a new low, and the RSI could not make a new low, right? So at the point the market started going up, it now got to this extreme. What happened? The price could not make a new high. Just as the price was making, RSI was doing this, the price was just flat, right? So this is a hidden divergence. So immediately the market hit the 240 EMA, and you can see the hidden divergence. It confirms your reversal, and that is what happened. This hidden divergence often occur around when you want to look for entry around the 240 EMA. So merely looking at 240 EMA and looking at price action around it and confirming it would have even confirmed this hidden divergence, because it's often a trade in the direction of the trend, continuation pattern, continuation move, signal for continuation in direction. Of course, you know that when the market is trading below the 240 EMA, it is bearish. So when the market make a pullback to the 240 EMA, you want to look for opportunity to sell. By the time you want to look at this level and look at the RSI, you see that the RSI is making an hidden divergence as regards, and that settles a whole lot of things. Right? Now, let's take a look at this also. At this point where the market rejects 240 EMA, at this point, you will see that when the market was coming down like this, right? So if you take a look at this level here, this is the level here. So generally, the market has made a new effort to form a new high. but RSI, I mean, the price could not make that new high. So the price only made a new low. So the market reject this 240 EMA. By the time this candle close, you take a sell, and that settles a whole lot of things. First and foremost, market come to the 240 EMA, reject against it, they form a bearish candle. Market giving you a hidden divergence, telling you that you should continue looking for a sell opportunity in the current direction of flow, and then you take it that way, and then you continue. That settles it. If this is complex and you possibly getting confused, engage me one-on-one. I will be very much happy to take you up and then put you through. Everything is still free of charge to your best interest. But you will not sacrifice your practicing side and then assume it should be clearer. No, unless you want me to tell you how to trade with color. When you see red, buy. When you see blue, sell. You're going to lose more than you will gain, and it's not what you want to bargain for. So that is about divergence. Now let's take a look a step further into our note, and possibly because we have to finish this obstruction moving average. We've talked about this, and then now moving average has what we call moving average. You use them in different ways. First and foremost, dynamic support and resistance, because the market, they always guide against the market, and market bounce around them. Like I said, the dynamic support and resistance in our market is 240 EMA. Then they also eliminate noise. So when the market is going up, you want to maintain buying the market, buy even while it's pulling back. So far, it's still trading above the 240 EMA. So the noise in this case is regards to be the pullback, which you don't want to, you don't want it to be a confusion. Now, trend barometer. Trend barometer is that we can immediately, you open the chart, you look at where the market is related to the 240 EMA, and then come up with a decision whether the market is bullish direction or bearish direction. So for the purpose of simplicity, we'll be dealing with and exploring two types of moving average, namely the 240 and the 55. The 240 is considered to be the exponential, Thelma, because it's called the trend direction, right? The trend direction, meaning the market, when the market is above it, you look for a opportunity to buy. When the market is below it, you look for opportunity to sell. So it gives you a demarcation of what the trend actually is. Then the 55 EMA will be referred to as water. Please, sometimes I may refer to this 240 and the 55 EMA as we progress. So, and in this regards, I will be calling them their nickname, water and Thelma. Now, for the purpose of this market, now the Thelma is used as dynamic support and resistance EMA, and often known as support and resistance EMA, while the 55 EMA is called the immediate trend. Okay, now you will see the application. For trading purpose, we look to buy only when the market is trading above the Thelma, and sell only when the market is trading below the Thelma. Whenever market is trading above the Thelma, which is 240 EMA, we will take entry on any candlestick closing above the water, or from below, or bouncing off the water. How do we mean? Now, this market is bearish because it's trading below the 240 EMA. The thick brown line here is the 240 EMA. So in this case, this market made a pullback, and as it makes a pullback, this candlestick rejects below the 55 EMA. This is where you take your sell. Your stop loss is going to be here, and then you will now use 2 times your stop loss, because the minimum risk you want, the minimum expectation we want to have from the market is at least 2 times our risk. If you look at a setup and what you are going to be expecting out from that market before you hit the next barrier is less than what you are going to be risking, that is a bad trade. We say we avoid market that has unfair risk to reward ratio. In this case, if your risk is 20, you should be expected to get at least 40 in that market. If your risk is 10, you should be at least expected to get 20 in that market. If your risk is 150, you should be at least expected to get like 300 in that market. Okay, that is how the equation is. It should be simple as that. So now let's take a look at this. When the market pull back to the 55 EMA, we sell on rejection of 55 EMA. Or let me say, when the market pull back into the 240 EMA, by the time it recovers below the 5 EMA, we do a sell. Mind you, most time when this market is doing it, the RSI will be hitting its resistance level at the 65 level. Like I said, look at it here. Okay. Coming further, trend management. There's nothing like entry buying without understanding your level of exit. So if you are considering a entry into the market, also know that there must be entry is equally important, exit is equally important. And this exit has to do with what is your take profit and what is your stop loss. Now, if you enter into a market and the top stop loss is 20, because stop loss is the first thing you decide when you take a trade. So if the stop loss is going to be too big, wait. But nevertheless, taking a trade when it is close to the 55 EMA or close to the barrier level is very, very important. So technically, our market is expected to hit the barrier level and then reverse. So taking the trade around the barrier will make us to risk small stop loss. So we can also make us to have a very big profit expectation, right? So now this is it. So 3 things make successful trading: the mind, the method, and then the money management. Or let me say the method, the mind, and the money management, or whichever the case, it circulates in that order. There is no one is less important. If you have a good trading psychology and money management without knowing when to buy or when to sell, you are just going to be continually taking trade out of guess, and then you will be like, after all, it's a small money. You just be like, after all, it's a small money, until all the money will go, because you don't know where to buy, you don't know where to sell, you don't know where to exit. The method is not there. Whereas if you have a good method and you do not have the right mind, the psychology of trading, what you do is that when you enter the market, you will start second guessing your method because your mind is not made up with that trade. Then you start like taking small loss or taking profit too early, or holding trade beyond unnecessary limits. When the trade is about to hit your invalidation where you are supposed to reverse the trade, you clear your stop loss, you start hoping that the market will come back. Please, hope is not a strategy. Don't hope when you are trading. Immediately your invalidation level is triggered, market change direction, you start buying, market change direction below 240 EMA, reverse, cancel yourself immediately, start selling, recover your loss and make profit in the new direction of the market. Money is to be made in both directions, not in one area. Now, what is money management aspect coming to do here? Now, before, if for any reason you have, let's say you have $10,000 in your trade, okay, you will not be using the same lot size with somebody that has $50 in this account, right? That's the truth. The truth is, the higher the larger the stop loss the lot size you want to make use of, then it has to be in correlation with what the balance or your equity is. If for any reason you are not respecting that, then you are digging the pit for whatever, then you possibly will like try to want to be attached to the system 247 because you cannot take your eye off. Your mind is attached to the money because you have done the wrong thing in the first place. Too much risk in the market, then you cannot take your mind off it. Then you don't want to, you cannot rest. Maybe you take a trade, instead of you to go and sleep in the night, you sit there like this from when you come back from work, like 7 o'clock, you sit there with your computer till 3, 4, 5 p.m. when you're supposed to rest. You now get to the office the following day, your high is like the high of mosquito or the high of frog. That is not how to do it. Use the right money management. For me, I recommend 2%. Let 2% be your guide. Sometimes if you have enough, use 1%. Less is better. Less is more. However, if you risk 1% and your risk to reward ratio is 1 to 2, that means per trade you are very much likely to get about 3 times, 3% of your account, isn't it? So let's say you have a win rate of 70%. That is going to be like almost 100% of your account on a month, every month, in and out. No investment will guarantee it. Just put your mind into the practice and the process, then the reward becomes normal and it will come to you accordingly. Now, for all our trades, the bar closing above or below the 240-55 EMA, that is the water, is our trigger bar. So let's say, for instance, now the market is like this. Let's say this is the market, and this is 240 EMA. The market is far away from it. We now use 55 EMA as our guide, right? Anytime the market is far away from 240 EMA, because the market will not want to come to that far, so we use 55 EMA as our guide. When the market comes to the 55 EMA like this, at this point, let's say it comes like this, the candle that is closing above 55 EMA becomes our confirmation trigger candlestick. Then you buy. Of course, you are prepared to buy because you know that the market is above 240 EMA, which means you are looking for a buy. But you are going to be using 55 EMA in this case to be your entry barometer. But when the market is close to the 240 EMA, let's say like this, let's say this is 240 EMA. So you don't, market has a tendency of coming to the 55 240 EMA like this and then bounce off like this. Okay, and that's it to say. So in a situation where the market is far away from the 240 EMA, use 55 EMA as your barrier lines. If the market is close to 240 EMA, use the 240 EMA as your barrier line. The 55 EMA is just a barrier line to help to guide you against missing out of a move in case the market does not make a penetration deep into the 240 EMA. So the two of them are very important on the chart, but the most important you need to pay attention to is the 240 EMA. You only consider the 55 EMA in a case where the market is far away from the 240, so the 55 becomes handy. So the 55 is just like a division of the 240 into small scale. So the 55 will trail the market closer than the 240 will do. So if the 240 is far away from the market, use the 55 EMA in place of the 240 as a guide to the market. So in that case, you are not even drawing trend line. You are not using the 55 EMA as a natural trend line factor, the 240 EMA as a national trend line factor. So the job the trend line does to the market, like if the market is going up, you put the bullish trend line. If the market closes below the trend line, then you reverse the trade. Abi? So also, you use the 5 EMA as a dynamic trend line in the market, trading the market as it is going up. So you are not you don't have a need to draw trend line again. So in the case of divergence, like I said, when the market is diverging, like this, you know, I told you all the time, when the market is diverging like this, I told you to draw trend line. Now you are not drawing trend line again. Once you can see divergence, apply the 55 EMA. So if the candle close above the 55 EMA, then buy. Buy with a target to market coming back to the 240 EMA, and that settles it. So the 55 EMA becomes your dynamic trend line. The 240 EMA becomes your dynamic support and resistance. Is it getting clear? So now you are not drawing trend line again. You now have a moving average replacing the instances where you have to draw trend line. Right? So it makes the job very easy. So anytime the market is like this, let's say this is the 240 EMA, right? You want to sell this market, but at where? This level. So if this market has a divergence at the low, wait for the market to a candle to close above 55 EMA, then buy. Use the 240 EMA as a target. Then if the market comes to 240 EMA and reject it, then you sell. But if the market close back above the 240 EMA, just look for a pullback like this and then continue to buy in the new direction of the market. It is that simple. If the market has a bullish structure like this, like you have a divergence, so 55 EMA will come close to the market closely like this. Closely. So if the market close above this 55 EMA like this, then you sell this market because these divergence tell you that the market is tired. Abi? So the close below 55 EMA is a violation and a change of trend. Abi? So you want to sell this market. So if you are selling this market, where you be your target will be the 240 EMA coming next after it. Abi? So if the market comes to the 240 EMA, this is where you prepare to buy back in line with the overall flow. But if the market close below the 240 EMA, then you look for a reversal. So you are taking a position to buy here with your stop loss few pips below it. So if the stop loss get taken out, then you take a trade in the new direction of the market. You need to be able to track this. It is the easiest thing I can do, and I expect it to be the easiest thing you can do. Now you are not putting trend line. Now you are not doing anything again. You are just using the 55 EMA in place of a possible trend line necessity in the market, and you are using the 240 EMA as your dynamic support and resistance. This is the whole summary of the intraday trading system that I work my life around in the last couple of 11 years in this business. So if I'm taking a buy at this point, I'm using this level as my risk. Then my TP, this is my risk, I'll be stop loss. So I will use two times my SL as my minimum target. But sometimes I can always hold this trade into a swing trade in such a way that I will be expecting a new high at this point. So my TP1 is going to be here, and then it's going to be like I'm getting like almost ×5 of what I am risking in this trade. For any trade I take, this is often what happens. If you cannot see a divergence at the top, right? If you cannot see the divergence, always consider that the market should make a reaction to the 55 EMA and bounce, while the 240 EMA is far away. But if the 240 EMA is close to the market, expect that the market will come to the 240 EMA and bounce if it is a bullish direction. But at any time the market values 240 EMA, please never hold the market with hope that it will come back. It will not come back. Oh. Don't hold the market with hope that it will come back. Once the 240 EMA is violated, the trend has shifted. Don't be believing into like, I have to give it space, let it breathe. If you give it 1 million pip distance, it will take it. Then you only lose more. So the 240 EMA is just a guide. So when you're taking a trade here, you put your stop loss here. I'm not saying you're not going to make a loss. Most times when you take this trade, it will continue going up. But in once in a while, when it goes against you, immediately it does that. Wait for it to pull back and reverse the trade, and then you recover your loss, and then you now make profit, and that settles the intraday basic system. Anytime you take a trade, use the previous zone here as your stop loss. Then your TP should be minimum of 2 times your stop loss. That is your TP1. If any reason happen that your TP is not going to be achieved because there's a barrier, maybe a demand like this, yeah, is there, then you don't take that trade at all. If your TP is not going to be better than what you are risking, don't take the trade at all. Pass. Now, money and risk management. This money and risk management, I will give the honor to Boss MJ to undo it. In our Friday class, we have a class on Friday, and this is the last class. Money and risk management will be handled by MJ Young himself. So whatever the money management he wants you to put, you will get to hear from him on Friday. Okay, but in the quick time, I will just do a quick short notice of just 1 page of this. What is money management and what is risk management? Are the two the same? Now, the two are not same. Okay, that is just what I will have to say. But I will send these notes to MJ, and he's going to anchor the class for you on Friday. Whatever he wants to add, we had it. But technically, your life will be better off if you never risk more than 2% per contract on any trade you're taking. Okay, because it will keep your mind at peace that even if the stop loss is taken, you can always recover it in the next trade. Okay, like I always say, learn to take the trade around the overall level. So this is the end of this my presentation. Only left with money and risk management and trader psychology. Just a class left, and I will give the honor to be for this session to be anchored by MJ Young. It is my ultimate joy that I have you up to this moment. I want to see you in the intermediate class so that we can trade live. Our intermediate class will not be happening in the night. It will be happening in the day when the market is moving. So when we look at the setup, we take trade. Before we end up this discussion, we see whether this thing is working or not. We can decide, right? That's how it's supposed to be, not be telling you what happened in the market 10 years ago. So when it happens again, take it. Then that is you on your own afterward. This is a live situation where we work hand in hand. So it is in your best interest that you take this advantage and run with it. Mind you, while you are learning, you can copy trade on IS Social free of charge. Bye-bye. Thank you. MJ Young, you possibly can now help us to round up the class. But before then, question and answer. You have any question, raise up your hand in the chat box. Then I will give the attention. You have any question, raise up your hand. Mr. Kabiru, Mr. Isaac, you have the day. Please unmute yourself.
Yes, hello, are you there?
Yes, I'm very much here.
Okay, so I just had just few questions I wanted to ask both the previous class and this class, but there was not enough time, so I just let it slide. So I wanted to ask a question. The levels to the MA and the RSI, I didn't quite get them. And also, if you assume you enter a trade, since you say the best time is around 8 a.m. to 10 a.m., then 1 to 3. So if you enter a trade, assuming let's say around 9 a.m. and the trade takes you up to 10, where the market is quite manipulative, how do you handle that?
Let's say you open a trade in the morning and the market did not move to achieve your TP before the end of the day. So you possibly, at least if the market is not moving, you will not, nobody will teach you when the day the market we must move. It's not like you enter the market, then the market must move. No condition like that. But if the market refuses to move as you plan out, first and foremost, this is what I do. There's what we call emergency exit in the market. Emergency exit is that exit you take in the market when that you create a time frame that is within a time frame of, let's say, between now and New York session, or between now and the end of New York, this trade must be achieved. If it's not achieved, whatever that is at the market, I will exit with it. That is emergency exit. However, if you happen to be a trader that maybe the trade has moved in your direction before the end of the day, that day, and the TP is not being achieved, what I always do is I will move my stop loss to break even. I will break even on the trade, then I can now consider it like let it run to the next day, as long as the condition that warrant me to take the trade has not been triggered. Now, this is it. Let me create a situation for you. Let me say I'm taking a trade at this point. Let me say I'm creating a trade at this point like this, right? So this is my 240 EMA, right? Okay, let me say this is my 55 EMA at this point. I'm taking a buy, right? So my TP is going to be here, right? Now, this market has gone this way. As it has gone this way, the market started refusing to go up. You know, my reason for buying is still valid because the market is still trading above the 55 EMA, Abby. So let's say at this point, the market is going to go up. But at this point now, I'm looking at my RSI is giving me indication to go down. And then this market now come up, RSI now come up, it can now close below this 55 EMA. What should I do at this point? My TP has not been taken. At this point, the reason for which I took this buy, because it's trading above 55 EMA, has been invalidated at this point. I don't have to wait for this market to come and take my stop loss out here, Abby, because I'm believing that the market should come back here. So it made the reason for me, for which I took the trade, becomes invalidated at this point. I will exit this market with whatever I have, especially if this level is a divergence, right? If this level is a divergence and I see a market close below 55 EMA, my job is to reverse the trade back to the 240 EMA around this level. Abby?
Yes.
I will not need to be holding this trade, but I will have to exit this trade, right? This is a situation by the reason the conditions that warrant me to take the position has become invalidated. Now, this is the second exit rule. Exit rule 1, emergency exit, meaning that the time frame I've set for the time zone I set for the market to materialize, I exit the market with whatever is available. The second thing is the condition for which they warrant me to take a buy. If it becomes invalidated in the future, I will exit that trade, even if the TP has not been taken out. That is condition number 2. Condition number 3 is the one that you will have to leave it to run to your target. But in this case, you will be managing the trade. So let's say you enter a trade here, you use 10 pips at this point. By the time the market comes to 20 pips, whereas maybe your TP is going to be 40 pips. When the market comes to 20 pips, I will move my stop loss from this 10 pips into this level. So no risk in this trade. Then I will now apply a trailing stop of 10 pips, Abby. So as the market keep moving 10 pips in my direction, my stop loss will keep moving closer to the market. This is what we call the ATM method. ATM method is a topic in the intermediate class, and we'll be discussing it, how to manage our trade on the active moment. Now, if this market is now going up, my stop loss will be following it accordingly. So when the market now decides to reverse, it will only take me out at the last set stop loss in the market, which is going to be automatic. I do not need to monitor the trade to get it done. That is the third form of exit. The fourth form of exit is for you to wait, for you to hit your TP or for you to hit your stop loss. But sometimes that could be a very dumb way of trading. But nothing can be considered to be completely dumb, because that which you consider to be completely dumb is wisdom somewhere else if you know how to maneuver it, right? I'm sure that answers your question, sir.
Perfectly, it does.
Thank you very much.
Yes. Please, before I asked one or two questions, I know it might be helpful to others too, but that's where I got confused. So, like, we have the technical analysis here, we have the candlestick formation, and then the indicators. So, is it better for you to concentrate on the one you understand more? Because all of them have proven, from what you are teaching and from my understanding, all of them have proven to be very, very, very resourceful. So do I now combine this, all of them, for a proper confirmation, or concentrate on the one I understand more? Should I come again?
I'm with you. When two or more factors meet at a point. Now, this is it. RSI at 61, RSI at 65. ED divergence. Then thermal tested, thermal retest. These are three different conditions, Abi.
Yes.
These are what? Three different conditions. But these three different conditions mean sell, Abi. So let's say the market is coming like this. So this is the high that was formed last. Then this is the 240 EMA at this point. Then on the RSI, this is what you have. This is hidden divergence, right? The market is making a higher high. RSI, the market is could not make a new high. RSI has made a new high. This is hidden divergence, Abi. Then this is going to be 65 zone. This is a perfect combination where you say the market is eating a supply, Abi, 1. The market is eating a 240 EMA, 2. The market has given you a hidden divergence, 3. RSI is at persistent point, number 4. This is a perfect sell condition. All factors are met at the same point. Are you there?
Yes, I'm here.
That is called the confluence. Okay. But more than often, if you want to, you can relegate the RSI if you can understand the market movement on the chart perfectly. But sometimes the RSI is just going to be as like an additional tool, telling you what the trend phase is like at glance. But even if you understand the position of the market to 40 MA, you might not need to look at the RSI at all. So everything is just done on the charts, and that settles it. And it's a perfect way of looking at the market.
Okay.
All right. Thank you very much.
Sir, please, can you just give me the single honor to just ask a twin question? It's much not relevant, but it's relevant in a way. Like what the tools you use, I discover I can't find most of them on my MT4 platform I downloaded to my PC.
All right, this is it. Let me make your job very easy. I'm going to share.
And the platform seems almost different.
Don't worry. I'm going to share my trading system with the members in the group in the intermediate session. So you will have it in the intermediate session, or the system, complete system, you will have it. So if you see an indicator or template, whatever, you don't need to bother yourself in creating it yourself. I'll just go to send you the file, then you just install it. And it's a very easy one.
Okay, that is resolved. Thank you.
But that is only within the intermediate community, sir. Thank you.
Okay, sir.
Next question, please. In the absence of no question, I'll welcome MJ to just help us out with one or two nuggets. Like me, this is time for me to learn. I learned in the beginning, and then I'm going to end with learning. It's not just going to be like me coming to teach. It's just a privilege. You also can be here tomorrow. So let me learn now. MJ, I beg, come and teach us something. Hello, sir, MJ. Okay. if it's not there, I would like to just end this meeting and then call it a day. Then please, on Friday, same time, we're going to be having a session on money management and the risk management. Then that will be anchored by MJ, and then we can call it a quit with this intermediate. Then the intermediate session will happen exactly a week after, so that we can practice what we have taught in this basic class on our demo. If you want to open demo, open. In fact, if you don't have a demo account as at last Monday, then you are not doing well. You are not doing well. You need to have your own demo and practice. At what level by now you should be preparing to open a live account. Okay, and that settles it. I'm sure you are happy. Thank you very much, and God bless you. Sayemdi, are you here, sir?
Yeah.
All right. Okay, I think the network is a bit poor, but I will know. Sayemdi, let me give. All right, sorry about that. Okay, maybe the network is bad now. So, all right, so let's end. Okay. All right, sir. Thank you very much, everybody, for being here. God bless you, sir. We'll be together again 9:30 on Friday, and then we're going to conclude this session on risk and money management, and then we can have our take home. Then we're going to spend a week interval to practice what we have been taught, and then we practice it whether in a demo or a live account. Then we make up our mind to now join the intermediate class if we so want to be. But I would love to have you all. This is in the intermediate class. I will pay less attention to indicator. I will pay more attention to price action. Okay. Now that is where I will talk about entry parameters. What are the key factors you want to see at your entry point? What if it turns out that your level of interest is became invalidated? Then what do you do? That is what you get. Then you will now enjoy trading more. Thank you very much, and God bless you. Bye bye. Sorry, do I have any question there? Thank you, Mr. TJ. Okay, bye bye.